Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to solve 10 different sample exam questions from the Accounting Fundamentals syllabus. So you'll get a bit of a feel for how I go about solving different types of questions from different topics from the curriculum, and yeah, hopefully you feel a little bit more confident and it gives you some ideas of how to attack some of these questions yourself on exam day. So yeah, let's get into it. Okay, so let's start with question 1. This is an irrecoverable debts question. So we're told that during the financial year ending 31st of December 2007, Simmons Co. received a payment of £150 from a customer whose £275 debt had been written off in a previous accounting period. In addition, the company had an opening allowance for receivables of £700 on the 1st of January 2007. And we're told that at the year end, Simmons Co. decided to increase the allowance for receivables to £790. So as well as debiting cash at bank of £150, which of the following entries must also be made to reflect these events in the accounting records? So let's walk through this question by looking at the two issues independently of one another. So first, let's consider the £150 payment that was received from a customer whose debt was written off in the prior financial year. When we originally wrote off that debt, we would have debited irrecoverable debt expense and credited trade receivables, or in other words, in last year's accounts, we would have treated the debt as irrecoverable and we would have recognised a loss in the income statement. Now that the cash has been received unexpectedly, we need to reverse that expense. So to do that, we need to post debit cash, £150, and to remove the charge that went through the income statement, we credit the irrecoverable debt expense account by £150 as well. So that will reduce the expense in the current year's financial statements. So that's issue 1. Now let's turn to the allowance for receivables. So we're told that the company had an opening allowance of £700. And at the end of the year, management decided to increase that allowance to £790. So that's an increase during the period of £90. Whenever we increase an allowance for receivables balance, we reflect that adjustment in the financial statements as an expense. So to do that, we need to debit irrecoverable debt expense by £90, and we need to increase the allowance for receivables, and we do that by crediting the allowance account again by £90. So we have our two separate adjustments that we need to make. Now let's combine them to give us an aggregate adjustment that we need to post in our accounts. So we have debit cash £150. We have a credit allowance for receivables of £90, and we need to combine the credit irrecoverable debt expense entry of £150 with a debit irrecoverable debt expense entry of £90, which gives us a net journal of credit irrecoverable debt expense of £60. So that's the journal we need to post to reflect these two issues, which means that the correct answer here must be option D. So we post, in addition to the debit cash, we post credit irrecoverable debt expense of £60 and credit allowance for receivables of £90. So that's question 1 complete. Let's look at question 2 now. We're told that Thomas is preparing a set of financial statements for his client Blue Wave Interiors Limited. He notices a small error in the stock valuation that slightly overstates the company's profits. When he points this out, the client asks him to leave the mistake in place, arguing that it's only a small amount and no one is going to notice. So Thomas agrees to this and submits the financial statements without correcting the error. The question for us is which ethical principle from the ICAW Code of Ethics has Thomas most clearly failed to uphold? Is it A, objectivity, B, confidentiality, C, professional competence and due care, or D, integrity? So the correct answer here is D, integrity. Integrity requires accountants to be honest, straightforward, and truthful in all professional dealings and communications. So by knowingly allowing an error to remain in his client's financial statements, even though it's just a small one, Thomas has compromised both the accuracy and the reliability of those accounts. Right, next up, we have an end of period adjustment question. So we're told that during the year-end adjustments, the accountant at Elwood Limited mistakenly recorded a £900 utility bill accrual as accrued income. What's the impact of this error on the profit for the year? Okay, let's break this question down and solve it on the next slide. First, let's think about what the correct accounting treatment should have been, i.e. what the accountant should have posted if they'd recorded this issue correctly. So a utility bill that relates to the current year but that hasn't yet been paid needs to be accrued as an expense. So the journal entry that the accountant should have posted is debit expense £900, credit accrual £900. So what impact would that have had on the company's profit? Well, it would have increased expenses by £900 because it would have been debiting the expense account, and therefore profit would have reduced by £900. Now let's compare that to what actually happened. So instead of recording this as an accrual, what the accountant did was they recorded it as accrued income. So that means they debited the accrued income account by £900, and they will have credited sales or income by £900. So that was the mistake that they made. So in other words, what they did is they treated this as additional revenue, incorrectly increasing profit by £900. So we've got two layers to this mistake. Firstly, the expense that should have reduced profit by £900 wasn't recognised, so we should have recorded an expense but never did. So that overstated profit by £900. Secondly, they actually recorded income of £900 in error. So the net effect is that profit has been overstated by £1,800. It's £900 too high because an expense that should have been present was missing, and another £900 too high because incorrect income of £900 was added. So the overall impact of this error is an overstatement of profit by £1,800. So the correct answer again is option D. Cool. Next up, we've got a question about non-current assets. So we're told that Chantel acquired a new piece of equipment for her factory at a cost of £400,000 on the 1st of June 20x4. She also incurred the following additional costs during the year ended 31st of December 20x4. She incurred assembly costs, £15,000, staff training costs of £2,500, and the cost of extended warranties was £6,000. We're asked what amount should appear as the cost of the equipment on the business's statement of financial position as at the 31st of December 20x4. Okay, so when we calculate the cost of equipment, the rule that we need to follow is that we need to include all the costs that are directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating as intended. In other words, anything that's part of getting the asset ready for use is capitalized, and anything else needs to be expensed in the income statement. So let's start with the purchase price. That's the base cost of equipment. That's going to be included in the capitalized cost. To include the purchase price of £400,000, that's definitely included. That's the base cost of the equipment. Next, let's consider the £15,000 worth of assembly costs. Well, these are definitely necessary to get the equipment into working condition. We need to capitalize those assembly costs then. So we add on 15,000 of assembly costs. They're directly attributable and definitely need to be included. Next, let's look at the training costs, so £2,500. While staff training is important, it doesn't necessarily improve or prepare the asset itself. It's more about the people involved, not with the machine itself. So these costs aren't directly attributable and are instead treated as an expense in the statement of profit or loss. They're not capitalized. Finally, we have the extended warranties of £6,000. And again, these costs don't bring the asset into working condition. They're a type of future protection or insurance, so they also need to be allocated to the expense account, not to the asset's cost. So the total capitalized cost is equal to 400,000 plus 15,000, which equals 415,000. So the correct answer to this question is going to be option B. Cool. Next up, we have a question about the calculation of net pay. So we're told that Sophie is an employee at Maple Trading Limited, and her gross wage for the month of April was £3,200. And we're given the following figures, which were extracted from the company's balance sheet at the end of April. We're told that her PAYE was £450. Her employer national insurance was £380. Her employee national insurance was £290. And her employer's pension contributions were £210. So the question for us is, what is Sophie's net pay for the month of April? So when calculating net pay, we always start with gross pay. That's the total amount Sophie earns before any deductions are made. So that's £3,200. To calculate net pay, we need to deduct any amounts that Sophie herself is responsible for. So that's the statutory deductions taken from her wages. These are typically PAYE income tax and employee national insurance. So from the information we've been given, we know that PAYE is equal to £450 and employee national insurance is equal to £290. So we take the 3,200, we deduct 450, we deduct 290, that gives us a net pay amount of £2,460. It's worth noting that the other two numbers we were given in the question were red herrings. The employer's national insurance amount of £380 and the employer's pension contributions are costs to the company. They're not costs that need to be deducted from Sophie's wage. Those numbers you would use typically in a calculation to bridge from gross pay to total employer payroll costs. You don't use them to deduct gross pay to get to net pay. So our take-home pay for April was £2,460, so option A is the correct answer. Okay, let's start question 6. So we're told that Switch Limited is finalising certain figures to include in its financial statements as at the 31st of December 20x9. The relevant initial trial balance figures that we've been given include trade and other payables, which excludes interest payable, of £57,500. And we're told that the company has 8% debentures as at the 1st of January X9, worth £250,000. On the 1st of April 20x9, the company repurchased £30,000 worth of its debentures at par. There was no interest outstanding at the start of the year. And during the year, the company paid interest in cash of £15,000. The question asks us what amount for trade and other payables, including interest payable this time, should be shown in the statement of financial position as at the 31st of December 20x9. So to answer this, let's start with the debentures. So at the beginning of the year, for the period 1st of January 20x9 to 1st of April 20x9, we'd know that the company had the full £250,000 debenture amount outstanding. So for this 3-month period, we calculate the interest accrued equal to the £250,000 par value multiplied by the 8% interest rate, and then we multiply that by 3/12 to prorate it for the amount of time we're looking at in this period. So that gives us interest accrued equal to £5,000. But we then know that on the 1st of April, the company repurchased £30,000 worth of its debentures. So from that point in time until year end, so the 31st of December, only £220,000 worth of the debenture remains outstanding. So for that 9-month period, April to December, we calculate the interest accrued as the outstanding amount of £220,000 multiplied by the 8% debt cost prorated for the 9-month period we're looking at. So that comes to £13,200. So the total interest that has accrued across the entire financial year is equal to £5,000 plus £13,200 equals £18,200. But we're also told in the question that during the year, the company paid interest of £15,000 in cash, which means that the interest payable at the 31st of December 20x9 is equal to the interest that's accrued during the period of £18,200, i.e. the total amount owed during the period, less the amount they actually paid off, £15,000, equals £3,200. That's the amount of interest the company owes at year end. And remember that the question asks us to calculate the trade and other payables amount at year end, which includes the interest payable. So to do that, we take the £57,500 worth of trade and other payables, which we were given in the initial trial balance. We add on the interest owed at year end from our calculations above of £3,200. Therefore, our trade and other payables balance as at the 31st of December 20x9 is equal to £60,700. So that's the amount that needs to be shown in the liabilities section of Switch's balance sheet, and the correct answer is therefore option C. Cool, let's move on to question 7. So we're told that Sammy's sole trade net assets were £62,000 at the 1st of January and £71,000 at 31st of December 20x5. During the year, she contributed £4,000 of additional capital and used £5,000 of business funds to pay personal expenses. She also withdrew inventory for personal use at a cost of £3,000. So the question that we need to answer is, what was the business's profit for the year? So for sole traders, we always apply this formula when we need to calculate profit for the period based on the change in net assets. So we use the formula change in net assets equals profit or loss for the period plus capital introduced during the period less any drawings. So first we need to calculate the change in net assets. So the change in net assets is equal to assets at the end of the year, 71,000, less assets at the start of the year, which is 62,000. That equals 9,000. And what we do is we set that 9,000 equal to the profit for the period, which is what we're solving for, plus the capital introduced during the period, which we're told in the question was £4,000. And we deduct the drawings made, which was £5,000 of cash drawings and £3,000 of inventory drawings. So if we rearrange this equation to solve for profit, what you'll find is that profit for the period equals £13,000. So Sammy's business made a profit of £13,000 for the year ended 31st of December 20x5, and therefore option C is the correct answer. Okay, so in this next question we're told that in the trade receivables account for More Limited, a discount of £211, which was taken unexpectedly by a customer, was mistakenly recorded as a debit entry. After correcting this error, what will happen to the company's trade receivables balance? Okay, so when a company takes a discount, the correct treatment is to credit trade receivables because the amount that's owed is reduced. But in this case, the accountant did the opposite. They debited trade receivables by £211. That means instead of reducing the receivables balance, they increased it. So to fix this, we need to follow two steps. First, we need to reverse the incorrect debit by posting a credit of £211. And second, we need to post the correct entry, which is another £211. So the net impact of making those two adjustments is a 422 credit to trade receivables, which leads to a decrease in that account balance. So the trade receivables account balance will fall by £422. Therefore option D is the correct answer. Cool. A qualitative question now. We're told that IFRS 18 presentation and disclosure in financial statements requires income and expenses to be classified in the statement of profit or loss into specific categories to improve clarity and consistency. Which of the following is not one of these categories? Is it A, trading, B, financing, C, investing, or D, operating? So the correct answer here is A, trading. Under IFRS 18, income and expenses must be grouped together into prescribed categories. So you've got operating, which covers the main revenue generating activities that the entity undertakes. Investing, which includes income and expenses from investments and from the disposal of non-current assets. And you've also got financing, which relates to interest, dividends, and borrowing related costs, so debt costs. Trading is not one of the official categories under IFRS 18. It might be a word we use informally, but it doesn't appear in the standard itself. So the odd one out here on this list is trading, and therefore the correct answer is A, trading. Cool. Last question for this video is a work in progress question. So we're told that Ferrier Legal LLP provides legal services to corporate and high net worth clients. The firm is preparing its financial statements for the year ending 31st of December 20x2. One of its client engagements involves preparing a legal due diligence report. And we're given the following information which relates to that client engagement. So the table includes 3 staff members. We have a partner who has an hourly rate of £120, an associate with an hourly rate of £60, and the paralegal has a £25 rate. And we're also given their budgeted hours for the period and the hours that they actually incurred on the engagement. The question asks us what amount should be included in the firm's cost of sales for the year ended 31st of December 20x2. Okay, so let's break this down. Cost of sales in service businesses is calculated based on the direct labour actually incurred on the client engagement. So what we need to do here is take the staff member's hourly rate and multiply that hourly rate by the actual hours that the individual worked, not the budgeted hours. You ignore the budgeted hours completely. So for the partner, they have an hourly rate of £120. They incurred 3 hours. Therefore, their cost is equal to £360. The associate has an hourly rate of £60. They worked for 7 hours, so their total cost is £420. And the paralegal has an hourly rate £25. They incurred 12 hours, so their cost is equal to £300. So we add these all together to get a cost of sales figure for the period equal to £1,080. That's the total direct labour cost the business incurred, and that's the figure that should be included in the partnership's cost of sales for the year. So the correct answer to this question is A. Cool, so that's 10 questions. Hopefully that gave you a bit of a flavour as to how I would go about answering different questions from the material on exam day. If you like the video, please smash the like button and consider subscribing. I make tons of videos about accounting fundamentals and the ACA more broadly. And I'll see you guys in the next one.